Apparently, I stand between you and cocktails, and after a long day, I am sure much needed. Um, I guess, for this segment, I just want to give you a little bit of insight into how we wired and how we look at the world. It's normally a presentation, I suppose, that I would share with the board. So earlier part was just accounting for Reimagine. I just want to give you a little bit of insight about the manager itself. So in terms of an agenda, it's a smaller book, only 6 topics to it. We were reporting an integrated report, which was a period ending March. So I'm going to give you an update in terms of what's happened since March to where we find ourselves today. Deep dive a little bit into our enterprise ecosystem. We spoke a lot about people, give you a little bit of insight in terms of how we see the people endowment, bit of views on capital markets, property fundamentals, and hopefully conclude. So starting with the highlights, very proud to have reached final close of 1.3 billion as of 11 November 2024, which means that Fund 1 is close to additional investors. And obviously, it's a very good endowment for us to grow from. Furthermore, we've successfully refinanced the investor commitment-backed facility, increasing it from 390 to 585. And this strategic move expands application of funds to brownfield as well as greenfield assets, clearly reinforcing our commitment to comprehensive and impactful investment strategies. I announced on LinkedIn, I think it was about 2 weeks ago, that we are very, very excited to welcome RNB to the partnership. Credit approved facilities of 400 million, which for the first time it's happening at the fund level, means our properties are going to be bonded now. So it's nice to have another partner that we won't just discuss the strength of our LPs as we've been doing with Duncan, but we can also look into property fundamentals and just a different eye in terms of looking at the same property opportunities. So welcome RNB, and thank you again for the confidence of walking the journey with us. And in the background, TT couldn't be with us this week, so she took ill. But we've been in discussions with British International Investments, or BRI. I'm sure you would have seen the headline of BRI and PIC striking a strategic relationship some weeks ago. We are looking at a structured funding or lending facility with them to support and leverage our greenfield development. And if you, I suppose, peer through, why we're doing certain things is because the fund is finite, we take our capital allocation decision very seriously. So how we utilize our equity commitments, especially on greenfield development. So greenfield development, if you get a small scheme like Khanyesa, which is 4,500, I think that thing from start to finish was about 8 months. If we're doing bigger schemes like Namakwe that you're going to see tomorrow, and Englobo, being bigger schemes take a bit longer. So to have equity really tied up in that process when it's not earning an income, it affects DPI, it affects IRR. So to optimize how we then utilize our equity, LPA does allow us to effectively manage the 60% LTV at the fund level, which means that on greenfield developments, we can actually get up to 80% and then normalize it at the end of construction and development to just make sure that our investors' money is working and income as best as we can. And moving on to capital deployments, which is one back, Unati. There we go. Thank you for the kind words. We've worked hard on capital deployment. I was joking at dinner that my come to Jesus conversation was when PIC joined this partnership. And Mauna insisted on meeting with all the LPAs to effect our first LPA, what do you call it? Revision, amendment. But by insisting on revising fees post-commitment. And at that meeting, I realized that the way this product works, or the way the fund works, is we charge 2% of commitments in commitment periods. At the end of commitment period in 5 years, in terms of that life cycle that I showed earlier, we start moving into asset management and exit, and the fee basis changes from commitment into effectively net investments. So it means now to manage our commercial risk of going backwards with fees for the manager, we need to get deployment to the other side. So whether it was intended or not intended, that's an effect that is had in terms of driving ourselves like relentlessly to deploy. So to have successfully acquired 13 properties, as we said earlier, to the value of just around about 950 million ZAR, 62,000 square meters in 2 years is quite a mean feat. It means we've been doing more or less a transaction every 2 months. So I do feel Chet when he says he's worried, but we do take leave. HR is just behind you. They insist that from, when is it? There's a period that we're not allowed to work in December. But since then, we're in the middle of 4 transactions to the value of 894 million rands, which represents another 44,000 square meters. It's been approved by IC and is in various processes. So I think 2 of those, plus the ones that are effectively we're refinancing from the Investec facility, because I think RMB is these 2 plus another 4, 6 in total, 5. So it's nice to have had another independent view looking at the 2 big properties that we are acquiring. But already, given where we are, it clearly is a record year again, because 894 is far more than the 550 that we did the whole of last year. And we are halfway in our reporting cycle. So we still have until the end of March 2026. Some good words have been said about our greenfield developments. So just to recap again, Lesedi was our first one, followed by Kenton-on-Sea or Ekhupumleni, which we opened more or less in May 2024 for phase 1 Lesedi, and end of November for the final Lesedi product. We completed Khanyesa on the 26th of June. That was 3,600 square meters. We started the redevelopment of Edgar's, Rustenburg, and Aliwal North effectively in March. So both those 2 should be complete by the end of the year in March 2026. Tomorrow you're going to see Ngamakwe. I think we went on site in Ngamakwe. It was around about Q4 last year. And clearly there's been one development that's been impacted by the rains that the region has experienced. It was challenging from an ESG perspective because it was the first resettlements that we had to do on that site. So also lots of interesting stories and learnings behind that. And Engobo is a very, very new one, which IC approved at the last meeting with few conditions that then became unconditional. Was it on Sunday, on Sunday. And then, but yeah, we went on site to break to, what did they call it? SO10 last Friday. We're buying the scheme from Billion. And it's a very interesting one when you connect all the dots. So in the Eastern Cape, the biggest city is Umtata. And clearly, the one big Billion development was the one that E2 ended buying with your partners. FNG, yeah, thank you. And the second largest city is actually Engobo. So if we had time tomorrow, it would have made sense to do it. But given that we need to leave early, and that one I think we're going to site on by the end of the month, which is in a week or 2. So we're very active on the development side, to cut a long story short. If we move on to people, we had our first team loss. So we lost Yanga, who left us at the end of March 2025. And Yanga had been with us since January of 2023. So we are very mindful of our development directors' well-being and capacity. And clearly, if you look at the developments that we have in progress, we've got a very active vacancy of a development manager that we are actively recruiting for. I've managed to consult briefly with some of my LPs to say, I think, hopefully by now, we've proven beyond doubt that we are committed to transformation. So if we employ a white male that's Afrikaans speaking, it doesn't mean that we are regressing. It means we are also true to inclusivity, which is what this is all about. But the other psychological reason for it is, I need to find the psychological reasons. I heard Sean is a psychologist, so maybe tonight we can just share a few notes. But we find generally in these markets that we operate in, because we look the way that we do, in the markets that we do, we have to deal things that other people that look very white and Afrikaans don't have to deal with. So I think it will go a long way in terms of helping us execute easier and more efficiently in terms of some of our developments. And if you move on to the next slide, which is really our operating platform, we parted ways with our previous property manager. I was saying to the team, actually, every year comes with a lot of changes within our company, which I guess is not willed, but it is what it is. And so Permanent left us at the end of the financial year, and we appointed JHI Accelerate, represented by Vicky and Efficient over there, and clearly quite excited in terms of that new relationship. You saw Phil, so we engaged Phil since July, I think it was, or August last year to help us develop our asset management model. And I guess at the core and essence of it is exactly that. If you are a small team, you've got two things to leverage. So what I've learned in my corporate life is that the likes of Old Mutual might have taken 200 years to establish their operating capability. The unfortunate thing about our business schools is that they seem to be informed by Western wisdom. Meanwhile, there's a lot of wisdom in the Deep South. And one of those is exactly what I said earlier, that in one of the proverbs, that it takes a small house to house 1,000 people. So we've just learned that our competitive advantage are the relationships, how we collaborate and how we partner. And how we do that, we still need to document it, but it is our competitive advantage. It allows us to have an operating platform that is institutional capability. So yeah, so the development work, as Phil and Jimmy said earlier, is almost complete. The piece that's missing, Belinda has been very kind to include us in a platform since, I think we signed our contract last year, August, if I'm not mistaken, but we couldn't execute it because we needed to get our data integrity in terms of the design of our operating platform correct. So clearly, as Jimmy said, we've deliberately chosen MRI as our property platform, and we insisted in appointing our property managers that they must use MRI. And reason why is data integrity, so that there's one version of the truth, one input, very important, because from MRI, it feeds into JTC's platform, who does our fund accounting team, which is based in Cape Town. So it just makes it easier for Nozipho as a CFO then to basically just review the trial balance that comes off the system, give that to JTC, and within no time we can meet your stringent reporting requirements. We also then, during the year, also appointed Anon IT as our partner. If we move on to the next slide, is effectively what we call the structure of the business. So at the top, as I said earlier, we're very proud to have secured the caliber of investors that we have. I hope you learned from the last panel that each investor is very different in terms of their needs, requirements, liquidity, asset liability model, or asset plan. So we're very lucky then to have found congruence and alignment with the investors that we have in the fund. And schematically, PRC with 500 million is still the largest at 39, Wikilet 15 at 200, EPPF at 200. and Ruskura representing Motor Industries, Telkom Retirement Fund, Copates and auto workers, making up the balance of 400. We've designed our system in a very interesting and unique way because I always find the conversations very interesting. So because we deal in real estate, we need a company that will be able to legally contract with the tenants on leasing, with the developers that we use and all the suppliers that we use. So our fund is called Reimagine Social Impact Retail Fund 1 GP. It's actually the fund or the whole co, because what we don't show in this diagram here is that all capital partners plays two roles. So we play the role of a GP, which is a normal GP in a private equity structure, as well as clearly operating under the management agreement. We were mindful in putting us of Regulation 28 in putting our structure together in the sense that it was chaired to insist that he needs to first see property before he sees private equity. And it's quite interesting in the debate to say, is property seen as private equity or do you see it as a real asset? Because in my view, they do behave very, very differently. And I tend to agree with Chet that an industry conversation to go a little bit deeper in terms of how those asset classes behave will be very informing. So we've got it as a guideline to own about 75% of our properties directly via title. And then clearly we do also provide an opportunity to partner with people or to hold some properties through SPVs. And I think earlier I did highlight the 4 properties that we are owning through SPVs, which are likely to be greenfield developments. I should say that in putting this company or enterprise together, as TD likes saying when you get a relax over some champagne, to say when she joined this party, it was just a cash shell. And when we started the process of writing the policies and designing the governance system, we always did it with the end objective of having an institutional quality capability. And we continue to do that. So if you look at how we've structured our board, it's very similar to listed companies. If you go deeper in terms of board charters, sub-committee charters, our board succession, team succession, cracky, we've got a policy for everything. And much to the annoyance of some of my entrepreneurial partners that just like to be let loose to do what they need to do. But it was very important to just build it as an institutional quality. And if you go to the next slide, it's also very much informing, and it goes back to the earlier point of what I was trying to say, is that you might only see 6 people or 7 people. We made a deliberate choice when we were building this business that we want to spend our time on what we're passionate about, which is property. And we chose then not to spend our time on an capability that is all about managing people. So we've put together seriously some serious partners that we have, whether it's via the quality of our legal advisors, and Keenan, you're now on the list, so you can leave me alone. Where we've added RMB, Investec has always been there, and a banking partner. Nedbank is still our fund corporate banker. We've got Musong doing our corporate secretarial, JTC I mentioned as our fund administrator, Mazars auditor, and a whole lot of partners that basically inform our property enterprise. And if you ask me why, besides just reluctance or preference to spend time more in property than anything else, it's actually the most effective and efficient way of actually running a business. Because if you think about it, as an example, I get access to Belinda's expertise, which is global, worldly. She gives us information on, she does a very nice media 360 of what's happening in property, in retail. I've got Phil and his team at TAP to help us develop, and so on with JTC. I don't have to get Nazipa's time taken up by whether people are debiting correctly, crediting correctly, and doing reconciliations. She can spend her time on strategic value add as opposed to operational. Likewise with JHI, They've got the capacity to pull from shared services to whatever. So I find it's a very intelligent way of having a world-class operating platform without necessarily making the investment yourself. Because unfortunately, our revenues are limited to 2% of those regulatory commitments. And then we've got that to pay the people, because Chet, you're correct, we still have to pay them because we're competing with the market. And still pay clearly our partners accordingly, and still be able to keep us vested and interested in doing what we do. And clearly the new partnership being Bollard, if I just add one more thing, because I think what was missing in your positioning is maybe our why, is he gone, is basically our why. Okay, so one of our whys is, if you look at how property companies have dealt the energy security issue, is through investment and an aggressive rollout of solar, batteries, solutions across all their portfolio. If you ask Itu how much Vukile has been doing that, it's a lot of money. I don't know where you're at, 600 million? Yeah. So for us to utilize our scarce equity doing that, we will never have DPI. Okay, I'll tell you that now. Okay, but to leverage Kudu's cash to do the capex on the solar rollout, including capacitating the utility part of it, it just is part of how we effectively or efficiently use our scarce capital to maximize returns. So yes, we obviously make the investment in terms of the smart meters, that's part of the normal capex, but it just allows us a capacity, because Itu employs engineers in his team, we don't have that, what do you call it, budget to doing that, but it just allows us to leverage the best in class and breed expertise to just allow us to execute. So if we move on, we've been talking about, investments. It is about diversification. It is about scale, especially when property is related. The reason we struggle with getting funding early part in the process before your balance sheet is credible and is likely to be approved by credit is exactly that. So we had to push hard to, as I said, get the portfolio to a number of assets that are diversified across different geographies, across different locations, across different sizes, so that we can risk mitigate then in terms of how we manage returns. So I guess the headline here is, as we speak, we'll announce, we haven't done it publicly yet, that when the two assets being number 15 and 14 go through transfer, which we are expecting next month sometime, it will effectively give us an additional presence in the Free State. So when we joke about it in our team, is that Tumi and I are Sotos, and we've given preference to others before we expressed our self-interest. So Free State is our homeland. So we're quite pleased to, at Free State with Welkom. Akon Park is a very beautiful property in Vereeniging. So you can see what we're doing is we are adding additional properties in Gauteng. We've got only one asset in Welkom. And because of the questions that many of you asked us in DD, to say now we've got a logical flow, right? We fly to Bloem, drive to Welkom, drive to Aliwal North, and we cover those ones, because the rest of the provinces are pretty much covered. So we can do, except for Aliwal North, clearly Kenton, Englobo, and Ngamarkwe is part and parcel of one journey. Cape Town, the two assets are 10 minutes or 15 minutes from each other. And then at least now we can take investors and potential investors to more properties than Lesedi, because I'm sure Tumi and Wasima and all of you are sick and tired of just seeing Lesedi, because there's one development that most of you have seen from pretty much cradle to grave. And the other one is number 16, being Tembisa Megamart, which we're still in process with. But effectively, a portfolio then that was 950 in March 2025, from what we see at the moment, we are already then at about 1.8 billion, which is quite exciting in terms of moving forward. And then if you go to the next slide, without, I suppose, taking too much time, we've spoken about a lot of the assets. Maybe one question that we haven't spoken about is that part of our processes to recoup or recover the financial consequences that we experienced with Ekhupumleni. We effectively inherited land in Sebokeng. So it's another development that we're adding to our development director's desk. So we've been busy, we've completed market studies, we've engaged retailers, and it seems as if where the land is situated in relation to the competitive environment, we will be able to come up with a product. I think IC Chair, you gave us until at least, is it next year, into the new year to come back with a feasible scheme. So we are working hard then towards doing that. And then that's basically kind of like completes, and you can see the levels that we bought the different properties at and the pricing. And then on the pipeline, as I said, Ngcobo is now finally approved. We move into ground, so it will move from pipeline up to the process line, and likewise with Tembisa Megapart. I think we're just doing DD, we're in DD on that one. And then the other SEN is Blue Gum Bush, which is in the Free State, so that will be the second asset to make sure that we don't have a isolated asset in the Free State. It's not too far from your property in Butadichaba, but it's more south. Nozipo calls it a lifestyle center, and then at deal committee, she was saying, but our mandate is not to do lifestyle. So we were quick to say, does it mean that our addressable market of people are not worthy of a lifestyle in terms of the products that we give them? But yeah, it's going to be quite interesting. And then we've got other ones in Molepo, which will hopefully then give us access into Limpopo. So all else being the same, whether it's the end of this financial year or the next financial year, will hopefully be in 8 out of 9 provinces. And clearly the difficult one is the Northern Cape, but it's not like property, we don't make a geographic decision. It's still a localized decision that happens to be in a province. But for us is quite exciting. But if you look at all those numbers, Denise, to your earlier question, you can see that our investment value takes us to about 2.6 billion. I know the reason Ish is here, and there he is. And RMB also said it's about deployment, but there are clearly additional facilities to get us to be fully at our capacity, because we do believe that we'll definitely be fully deployed, as in the fund will be fully invested by March 2027 in terms of timeline. So yeah, so that's lekker. So if we go to the next one, which is just highlights, yeah, I'll say we are kind of like achieving most of what we wanted to do on the ESG side. Just on corporate governance, the one challenge that we're still dealing with is around governance with our SPV partners. And just to give you an example, I guess, is when you get partners in the markets that we operate in, I guess is not as straightforward as doing a deal or partnering with Wikila, who is a B2B property person that understands what you're talking about. There is power asymmetry at the one instance, and there's actually lack of trust at the second instance. So it becomes then very, very important to have proper governances so that you separate the owner to the new core and how it's actually managed. So we've had to, with our property managers, say, don't just report to us as the owner, just understand that we are in a new core or SPV, and that SPV needs to clearly mandate the property manager, mandate ourselves as the asset manager and development manager, and also separate shareholder reserve matters with the board so that you don't get confusion between an owner that thinks that they are a director in one of the two things. So we're cleaning up. That's why it's in progress on that line. And on the third line, which is basically implementing a little bit more of ESG in terms of acquisition, design, or construction. We've started executing or edge certifying our buildings. So clearly it's easier to do it on green buildings than it is to doing on brown. Yes, we are a member of the Green Building Council. We are working with some of our funders to basically help facilitate that progress. So the chair of SECT, I don't know, every meeting she's on our case about how we're executing in that regard. So we made good progress with Khanyesa, and clearly Ngamakwe is early enough then to do it properly. And I know from RMB we've got an incentive in terms of better margins from ESG that we want to come back for. And then on the last line being climate change, what's in progress is what we spoke about earlier, to say, yes, we can now measure and monitor and report on how much energy we're using, the intensity of that energy, but what we haven't done are the calcs in terms of carbon emissions, scope 1, scope 2. So that is a work that Hungary is busy working with. On basically how we are aligned as managers to the needs of the fund as mandated by the partnership, we manage our affairs in terms of a balanced scorecard. And if you look at that balanced scorecard, so Terry was correct that with PIC, there are penal measures. We try to make it an incentive as well for our performance, but it was just asymmetrical, whatever that word is, only looking at the stick as opposed to the carrot. But if you look at our balance scorecard, it's about all the variables that are important, right? So if you count the performance measures, so building performance is what we use to effectively manage, I'll say, the short to medium term building performance. That's where we look at vacancies, occupancies, arrears, and all that stuff. The second one, which is investment performance, starts talking to the long-term picture, Adam, which is where we manage the running internal rate of return that we are projecting, as well as clearly what we are achieving in terms of what's trailing. ESG performance, I always say where we are in terms of life stage is just gathering data to establish baselines. So we're not quite in a position where we can hang our heads and actually target. We're still refusing that, but as we get more comfort with the data that's coming out of our portfolio, it will make it easier then to say for a property that is 5,000 square meters, this is where the benchmark should be in terms of utilities. And for bigger properties, because you get economies of scale, this is what it should be, and actually holding ourselves to account on it. So we're not quite there, but we're definitely getting the data and developing the platform. Origination is key, so it's about 20, and origination talks to both for us. It talks to capital, it talks to assets deployment, and we think about capital structure holistically. So we don't just consider equity, we consider the full capital stack, which includes debt and credit and other forms of finance in terms of how we allocate our capital, how we make our capital allocation decisions to maximize our investment performance. And to Mada's point, operational performance is key. Yeah, life, you do get blow-ups, but risk management says that at least anticipate it, be aware of it, and have a management action in the case that it happens. So yeah, we review all our business partners in terms of performance of SLA and how stable or lack of khokhos that we got to experience, and that's about 20% of it. So the point of this is to just show how our incentives or what drives us day to day is aligned with the objectives of the fund, and this is what our STIs are based on. if I then take clearly carry as an exit thing in the future. So if I move on to enterprise ecosystem, yeah, to us it's about people first, it's about performance, and it's about community. So if you ask me what are the three hard guiding rails that guide us, is basically those three things. And we understand that for our party to happen is about capital. So how well we look after our investors, how well we understand their need, their requirements. And as you can see, it's in gray, but maybe I should highlight it, that those returns that we provide to our investors are absolutely key. So our hurdle rate is CPI plus 6. Theoretical one is a 10-year cost of money. And clearly we incentivize to perform higher than that in terms of IRR. We've, as I said, look at credit as well in terms of our capital stack. So we clearly also understand that the relationship with bankers is, one of those. When you sign that contract and you agree to those fees, it's all hunky-dory. But we also understand that it quickly changes if you don't meet your repayment profile or you default, because it goes from one to the other. And as we all know, there's only one reputation. So I say is one thing that we hold sacred in terms of basically how we go about. So capital is important. It allows us to develop properties. It allows us to acquire properties. Our properties is a consultative process, but clearly it needs a value proposition that attracts clients, that will attract shoppers to come and create enterprise from. And being an impact investor, community impact is clearly quite important and key to it. So if I focus on people, we've said it, it's all about trust and confidence. So I remember one board member that joined us, and the very first board offsite, all we did was to spend time on Enneagram. And then this member was like saying, are you guys a property business or an HR business? Why are we spending time on Enneagram, which is about analyzing personality types, as opposed to coming up with mandate or business plan? But the reason why is to Itu's point, that it is all about people. So clearly, that's a trust equation, by the way. And we try to employ on credibility. And reliability is generally how we show up, whether we say what we say we do. And authenticity, as we've been talking, is very important in that equation. So again, we meet religiously every month. We dedicate, I think it's half a day, on team dynamics, which is the safe space that we create, that Zach facilitates on our behalf, and we just deal elephants in the room. So I've been target of those for most of our time until now, and I'm so glad that I'm not a target for the next one, so that should be quite interesting. And then clearly what we guard against is self-centeredness, right? To say in any system, if it gets bullying behavior, grandstanding, backstabbing, betrayal, gossip, sabotaging, manipulation, all those behaviors of dishonesty, we don't tolerate those. And if you look at the events that I've more or less spoken about without speaking about them, it is like zero tolerance. It's primarily why we've also exited some of the relationships that we have. The other one which I like, which the chair was referring to, is called Constellation. And just to give you a nice perspective. So Constellation is process work that is used for transgenerational trauma management, right? And we manage the word trauma because a lot of us undergo trauma, whether it's through family or immediate relationships. Some of us as our corporate experience, anyway, whatever your source of trauma is. And then the essence of that model resides on 4 tenets. It's on belonging, place, time, and exchange. And I've come to realize that everything is around those 4 things. So if you think about it in the context of family, belonging is what we try to create, to say, as a team of alts, as diverse as we are, do we belong to this entity, and does everyone feel that it is their entity? The minute belonging is out of kilter, you've got a problem. Place is also important. So I'm the firstborn of a family of 3. So that is my birthright. So I've got a brother who is very competitive, and I have to remind him that I am the older one, and there's nothing that he can do about that. And likewise with my sister. So within the context of team, places, when did you join, and all those things. They're very subtle, but they're actually very, very important. And clearly time. We say trust and confidence is a time process. So we tend to like or trust people that we've had experiences with over time, and we mistrust new relationships. So I was very curious in a panel in terms of, I guess, views of emerging managers and whether you continue with them or not. Because I guess in essence it's a trust and confidence thing. And the first point of contact is courage, right? Is taking a risk. Because all of you are here because someone took a risk, and hopefully you're still here because hopefully trust and confidence is in the process of being built. And very importantly is exchange. Fair exchange basically says that if I put the effort that I put to anything, the reward equally must be fair. Otherwise, you get misjudgment. So long story short, we spend a lot of time in terms of trust, so I agree with that. And if you go to the next slides, I mean, our team charter got informed by the team dynamics work that we did. And if you look at all those words and what they mean for us is basically the essence of what keeps this team together. If you go to the next slide, there's also an output of team dynamics to say, yeah, it's easy in a small team. Actually, it's not easy to duck and dive in a small team, but it is very easy to be fluid, right, in terms of roles and responsibility. So we spend time literally describing our roles and responsibilities, understanding the dependencies and interconnectedness in terms of what we need to do, what you are empowered to make a decision on, what you need to escalate, and, because so that when we spend time together, we can only spend time on making choices that are evaluating and relevant as opposed to asking a leave form to be signed. Which is, I guess, what some systems do. And then if you move on, we've also done a lot of navel gazing in terms of what works for the system, what doesn't. So yeah, we're quite proud that we've got a very good board and team. And I say to most people that the way that we also relate to our board is very different to normal companies. I think our board is our soundboard, is our support. They are pretty much at beck and call. When we have our IC and board meetings, it's a whole day affair that starts at 8 up until 6 with a family lunch, as we call it, and some drinks afterwards. And which is great. It's like, I see it's working well with some of the banks in terms of, because credit meets each week, you know what I mean, you get a rapport, you understand how people think and operate. So we try to emulate the same within an investment business. I've already gone on about how great our investors are. I think that's great. The credible partners, the pipeline that we have, and clearly a very much active line of sight in terms of understanding what we are here for, which is to maximize returns or generate performance. So the 3 things that are not working well, and hopefully you'll see how well we're mitigating it. We learned through the Investec process that our structure is extremely complex. And our structure remained complex in the first 2 years in terms of just getting the banks to get our heads around how it's done and how they should treat corporate guarantee vis-a-vis bank guarantee, how LPs and those commitments are actually currency, which is what Duncan sees, but the others, because the other looked at property finance or did not look at the fund, did not see any of that. But it's the same complexity that we are experiencing in terms of executing deals. I don't know how many times we have to explain to conveyancers. It takes 3 weeks, and we think they understand. The next thing, they do complete opposite, and then it delays the transfer of the properties. So one of the actions then that we've got is to say, fine, we understand our structure, so let's just normalize the legal construct of our documentation so that we can get third parties to respond to ours as opposed to having to respond to theirs by explaining ourselves. And Competition Commission, same WhatsApp group. And I suppose we've been saying we're also in early stages of digital adoption. As I said, the first phase was just the design of our enterprise system. Data is king, technology is what gives us leverage. And hopefully during the course of today, you've seen how we are leveraging technology with utilities, how we are bringing technology to our asset management decision-making pool. And we'll do more and more of that. It just allows us to do more with less. And our hard reality as well is that smaller properties are troublesome, extremely troublesome in terms of the properties in the 2000 area. And I suppose having understood the different sizes, we see 7,000 square meters as a sweet spot. But if you look at the sizes of these 4 S's that we bought, I can't remember the sizes now. One is, how big is Beckham? 8,000, other one 12.5. But anyway, it's all bigger assets that basically help us tilt the portfolio to de-risking it. And clearly it means now that when we speak in 3 years' time, the tail end of the portfolio is going to be the small properties. Or if you ask me the question of DPI, what are we likely to exit first? It'll be those small properties because it's the reward and effort are not really aligned. All right, I'll be very, very quick. I just wanted to share with you, I suppose, thoughts on capital markets. SAFCA does a very nice survey which canvasses views of the industry in terms of how they see capital markets. So what's interesting is that 60% is anticipating high deal-making activity in the year 2025. Only heard Chad mention the word private credit, but it seems to be preferred by 86% of the LPs as a solution. ESG is still pretty much a top strategic allocation priority. And for Southern Africa investors, geopolitics is a big issue among allocators. So is the oversaturation of the market and deals drying up. 33% are expecting significant increase in fundraising in 2025. I'll show you a graph just now. And in terms of Southern African allocators, most of the AUM related to alternatives is actually allocated to real assets and infrastructure to the extent of 42%. So again, I see differentiation between private equity, private credit, real assets and infrastructure, which is why I think differentiation of the space is going to be quite interesting because I do believe those asset classes behave differently. But yeah, infrastructure, healthcare, real assets is still pretty much dominant. If you go to the next slide, which talks about ESG and impact investing, I guess LPs, as I said, LP support is considered for buy-in on ESG strategies. There's a lack of quality data that is emerging as the greatest barrier to ESG progress, which is how then, as you can see, we're differentiating ourselves by providing transparency in terms of data and measurements, and Hungry and Aquilators have been doing a great job in terms of helping us with that. How are firms driving transformation? Yeah, in 2024, 43% of the firms had boards with only over 30% women, which was down from 49% in 2023, and highlighting clearly the need for increased efforts to boost women's participation in the industry. I think the whole country is still pretty much challenged with that. But the share of PE firms with greater than 30% women representation in the portfolio company's executive management team have increased from 23% from 11% in last year's survey. So there is movement in the right direction, and whether it's enough or not is up to the bosses, I guess, to encourage the industry to move in the right direction. But yeah, but industry is transforming. So 72% of PE firms are greater than 50% black management, which is up from 62. And if you move to the next slide, yeah, it just shows that capital allocation is a challenge for the industry at large. So 2023 was a big year of 28 odd billion Last year was a dry year of 8.4 billion. And you can see that the difference between asset allocators in South Africa vis-a-vis outside of South Africa last year, or 2023, was just about outside, with probably, only 10.5 billion, an increase from 2022, but a decrease to 4.6 in 2024. So, so I can relate to lack of liquidity or the private equity industry not existing to provide the liquidity for capital raising. So that clearly remains a challenge. I'll skip the next slide. And next slide is just information. I'll skip the next few slides, actually. And then let's go to property fundamentals, and I'll say just a few things about it. I mean, the reason we like property and how we think is differentiated to a lot of private markets, it is predictable, it is reliable in terms of an income stream. All our cash flows are contractual. We sign leases, we know that they are 5 years, 3 years, 7 years, 10 years. We know the escalations that inform it. We budget very aggressively with our property managers to control costs. So, and whatever we do, even on construction and development, is all contextual. So in terms of having, there's nothing like certainty, but we definitely have clarity in terms of our contractual flows. It's one attribute that I think makes property an exciting asset class. On this series, and this is MSCI data, very high correlation clearly with GDP, which is a good thing. And on the next slide, the way that we look at it, there's two components to what drives property returns. One is income, the other one is capital. Capital is always a reaction because it's just a function of valuation, but income, we believe, is within our control in terms of what we manage. And it's quite interesting that if you look on this time series, which goes back to 1997, there's only 1, 2, 3, 4, 5, 6 periods in all those years where capital returns have actually been negative. Again, it's predictable, it's reliable, income streams. And if you go to the next slides, I guess, is a lot of internal conversations that we have. Like I said earlier, our 62% expense ratio or cost to income is clearly not good enough, and we need to reduce it. Clearly, a lot of that is driven by utilities in the main. And if you go to the next slide, there's still the usual suspects. Electricity drove pretty much 15.5% of the 3.2 variance, which is quite high, and which is why Bolite for us to help us arrest it. If you go to the next slide, again, within property, how industrial behaves to residential, office, and retail, they're all very different, I suppose, drivers. So industrial has actually outperformed on the back of logistics in the main. So we've all seen Checkers 60 and Woolies Dash, and it's amazing the disruptive impact that is having to retailers. What the likes are thinking about is the leases that we have with the retailers doesn't quite capture, I suppose, the e-commerce aspect of it. And now, how do you renegotiate that? Because bottom line is sometimes the fulfillment happens from your stores, which then will be covered by the lease, but sometimes it happens from a DC directly to the consumer. So how do we deal those elements of disruption? So, I mean, I heard Mantuka earlier talk about expanding mandate, but I think there's probably a case to be made for value chain expansion. So I think naturally for us, logistics seems to go with retail, but we'll see. I'm not implying anything, I'm just making an observation. But to Belinda's point, retail has been very much resilient as an asset class, and in particular, the markets that we operate in pretty much from COVID. So to conclude, just to remind you that we are pretty much aligned in terms of how we measure what we do and what keeps us honest with the needs of the fund and the investors. In terms of our priorities, which is the next slide, as we've been highlighting to anchor it, it's about completing the asset management model. And the one major piece is to sort out the benchmarking. So there's a lot of work that Belinda, Phil, and the team needs to do between now and, let's say, the end of the year. We're very pleased with the partnership with Bollight. As I said, one way, it just allows us to better manage our energy security. But from an expense ratio perspective, I mean, you'll be surprised how much leakage there is in our working capital management of our utilities. What I mean by that is that we get our rates bills from council or the municipality, and literally there's 90-day cycle with the retailers, and some retailers are very difficult to recover from. So we're literally subsidizing the retailers, and I think is not fair. But I think with technology, we can close that gap, which is how we enhance margin or reduce cost-to-income ratio in terms of what we're expecting this partnership to do. I think so far we've held our inaugural investor AGM. Thank you for coming and participating. Again, I'm very humbled that we managed to get all you busy people. I started counting after we got to 3.9 trillion that was sitting in the room. I started looking at the market cap of Investec, and it kind of like came back in pounds. And then I lost count of the digits, and I looked at first range, and yeah, then I realized that seriously, it is very expensive time. We clearly take very seriously the choice that you've made to be with us, because we do understand you've got a lot of other competing reasons. As the chair said, yeah, we are conceptualizing Fund 2, so it's probably part of the work that we'll do the end of this quarter next. So please don't drop the phone. Chad, please, I am still hungry. Allow me to take you for lunch or whatever. But we will do consultation with all of you to just get your views, to just help us to just think about it. But yeah, it's something that we want to take to our board by the time we meet at the stress session, because we do believe that we'll hit the 75% trigger by the end of our year end, being March 2026. And Hungry is still part of our KPIs, the ESG measuring and reporting, and which is what I highlighted earlier. And that's it. Baie dankie. Did I do well with time? Yes, as I fail with time, eh?